Yo, what's up you guys? Welcome back to another video. In today's video, I want to educate you guys on how you can gauge or how interest rate decisions are being made. What data the Feds look at to gauge whether they should hike interest rates or not, whether they should just keep it as it is, and basically how I do things, right? So without any further ado, let's get straight into it. You guys obviously know I'm going to use Fastbull. I will pin a link in the comment section below that you can go and download Fastbull, because all of the information I require is free on Fastbull. And they also got an app and they got some AI signals that you can check out as well. Now, the first thing I obviously need to explain to you guys are the following two things, right? There's something called CPI, and then there is something called rate decision. Now, a rate decision refers to interest rate decision, right? Now, the CPI works directly with a rate decision. Also the 10-year bond yields as well, right? If the 10-year go up, you can expect the Fed's more likely to hike those interest rates, right? But to make it easier for you guys to understand, what I am going to do is I'm going to take interest rates, and you have to listen to me very carefully, right? We're going to take interest rates there, and we're going to put interest rates right here. Now, when the interest rates, and then we're also going to add the most important currency, which is the dollar index, which is the world dominating currency currently in the world. Now, these two, they basically work in the opposite way of this to work. It's the same as being negatively correlated. But sorry, in this case, they basically work the same. Now, let's firstly talk about CPI, and then we can talk about rate decision and there. Now, to get the CPI data, we're going to come over to the data on Fastbull, and we're going to come to US CPI standardized, and this will give you a complete overview of the interest rate decision, and basically it's broken up here as well so that you can see what the CPI inflation consists of as well. Now, let's talk about CPI. The CPI is the Consumer Spending Index. It's an indicator used by the Feds to measure inflation. When inflation goes up, when the CPI goes up, the Feds only has the interest rate at their disposal to bring down inflation. It's the job of the Federal Reserve to make sure that they bring down inflation, that they keep inflation low. Now, the CPI and the interest rate is like it's like a park. When the one goes up, we have to bring the other one there so that they can basically balance out, right? So what we have here is, if you see inflation is starting to cool down, you can expect most likely for the Feds to not hike the interest rates or to keep it at what it is basically, right? Now, remember that when the Feds does not hike the interest rates, or the Feds lower the interest rate, that means the interest rate will go down, and that means the dollar will weaken as well. Now, why does that happen? It's very simple. When inflation's high and the Fed's only indication to bring down inflation is to hike interest rates, right? What that does is that strengthens the dollar index. Why? Because higher interest rate attracts international investors to invest into the dollar index because they're going to get a higher return. But when the inflation cools down, or when it comes down, what the Fed's most likely to do is they either going to keep interest rates where it is, or they're going to lower it. And once they lower the interest rates, the dollar index loses its value over time, and because of that, investors are not likely to invest in the dollar index. Therefore, you can expect the dollar index to go lower. So what can you take away from this quickly? Low CPI means the Fed's either going to lower the interest rate, or they're going to keep it stable, meaning it's not that good for the dollar index. Higher CPI means the Fed needs to cool down inflation, or the CPI, And the only way they can do that is to hike interest rates. Why is that? Because they need to discourage consumers to spend. Now, when you increase the interest rate, you basically increase consumer debt as well. So whereas consumers had money to spend to increase the consumer spending index, their overall debt has now increased by hiking interest rates. So any debt attached to interest rates such as home bonds, loans and car installments, that automatically increases in value as well, giving the consumer less money to spend. And because of that, the consumer spending index will go down. And by definition, the dollar index will lose its value, slowly. But you can also expect the Feds to lower the interest rate. Now, that also ties in with the non-farm payrolls, because when consumers spends less, companies that are listed on the NASDAQ 100 like Apple, Amazon, Google, all of these companies, they generate an income through consumer spending. If consumer spending drops, that means less people are spending money. It means that these companies are not really making any money, and therefore they need to lay off people as well. Now, let me show you some examples of what it is that I was speaking about right now. Now, like I've said before, let me just bring this back. When the consumer spending index is low, you can expect the interest rate to come down and the dollar index to weaken as well. Now, we're going to take a trip back into 2020. Remember what happened 2020? In 2020, we had COVID, right? So we're going to... let me just do this quickly. Let's go back. That's too far back. There we go. Okay, so this is basically when COVID happened in 2020, right? Now, I want to show you what happened over here. Now, from here is 2020. You can see what happened. So when COVID hit, everybody was stuck in the house, meaning that, let me just say it to you like this. Consumers were stuck in the house. So consumers weren't out there spending. So the consumer spending index was low because consumers weren't out there spending. So what do you think happened with the interest rate? Well, according to this graph here, interest rate should have been low as well, because remember, inflation's low. So we're going to take a look whether the interest rates were low or not. For that, we're going to go over to data and we're going to go to policy rates. Now, the policy rates is the interest rates for each country that you can see over here. And we're looking at the Feds. We're going to go back to 2020 and we're going to go to March. Now, what it is that we are looking for is we're looking for low interest rates because the consumer spending index went down. And because of that, we also need to get a weaker dollar. So let's see what happens. There you can see the Feds kept the interest rate at 0.25 basis point for that entire duration of 2020 into 2022. If you go look at the CPI, you can see the CPI was kept quite low for the same duration. And this is basically where things started to pick up. Now, see what happens. As inflation went up, before we get there, what I want to show you is, let's go look at when COVID took place, right? COVID took place in March of 2020. So we're going to go take a look at March of 2020. Here we go. Okay, so this is basically the March of 2020. Is it here? There we go. So this was March of 2020, and then this is basically where we could see that inflation started to increase in in March 2021. And you can see over here in 2021 March, we can see over there. But in any case, we had to focus on the bad things first. Now you can see over here how weak the dollar became there. The dollar became weak because CPI was low and the interest rates was low as well. So that means lower dollar. Now let's see what happened. From here, we can see, let's say from March, within a year from now, people started getting out. People had all that money when they were trapped in the house. When people got let go, people was like Jordans, Nikes, iPhones, you name it. And because of that, the consumer spending increased. Now, remember, the consumer spending increased between March 2021, it reached an all-time high in June 2022. Sorry, we're going to stop there. So the job of the Fed is to cool down inflation. So when inflation started to increase, what do you think the Feds did? The Feds started to hike the interest rate. Can you see there? In March, with inflation in 2021, March, inflation started to increase. And here you can see in 2022, in March, the Fed started to hike those interest rates, because that is around where where inflation was at an all-time high. Now the job of the Fed is to cool down inflation. They have to bring down inflation. Since June 2022, the Fed was like, okay, we have to bring down inflation. So they started hiking interest rates. Now, keep in mind, since 2022 March, the Fed has been increasing the interest rates since the 26th of July last month, and has been kept at a 5.5 basis point. What do you think happened to the dollar index since the time the Feds hiked the interest rates and since the inflation reached an all-time high? Remember, the Feds only started hiking interest rates from 2022 March. Let's see what happened. 2022, where are we now? There, right here. This was the pivot where here, right at this point here, from here, the Fed started to hike the interest rates all the way from it was March. Did I say March? There we go. From March, the Fed started to hike the interest rates and the dollar index increased in value. Now we can see here the Feds had kept the interest rates very stable since July of last month, and we can see over here since last year October, it's about 2 months. Because the Fed has been keeping the interest rates quite stable, the dollar index took a U-turn. Because remember, these guys want to invest their money into currencies that are doing well, that are increasing their interest rate to make more moolah paper. So because of that, the dollar index has now basically traded within this range. We saw the dip, and now we can see the dollar index has basically pulled back to pre-pandemic levels where we were 2020. That's basically where the index was at one point, and then from here, the only thing that we're waiting for now is to see whether or not the Feds are going to basically hike the interest rate or not. Now, to give you some more context, if you understand what I've explained to you now, you will also understand how the NFP falls into this. The NFP is called the non-farm payrolls. Why? Because it gives us information or data of companies that is not farming related, which is why it's called the non-farm payroll. Jobs are created through increase in revenue. Revenue is generated through consumer spending. Now, if you remember what I said, that the Feds only has one thing to bring down inflation. Now, when inflation is this high, you can expect job reports to be also producing some high numbers. But if the Feds hike these interest rates, these numbers will start to go down. That means that companies are not making as much money. And if you go look at the latest jobs report, or the jobs report we've got month over month, you'll see most of the time the unemployment had either stayed the same or basically not much had happened on there as well. Now, to put all of this in context for people who's going to skip through the video, it's easy. When CPI goes up, there's a higher possibility for the Feds to hike interest rate, and you can expect the DXY to go up. Now, let's look at what happened last week. Last week, we know that we have had, I think it was on Tuesday. So if you look at the index today, right, I'm so confused. What's the date? The 19th. Yeah, it was last week. I mean, maybe I'm looking at the right one. Yeah, I'm looking at the right one. There we go. US CPI data came through, and it came through higher. There's a high expectation for the Feds to come through and hike those interest rates tomorrow, because inflation hasn't shown any signs of cooling down yet, but we will probably see exactly what happened. But that is basically how I read interest rate decision using a method that's called a regression analysis, where you apply historical information to make better future decisions. That is it from my side. Thank you for your time, and as always, cheers for ears.